Whilst UK incomes have stagnated in the UK in recent years, UK's net wealth has increased from 3 trillion in 1995 to over 12 trillion last year. The biggest rise in wealth is not due to productive assets, but passive wealth, basically rising house prices. In recent decades, the ratio of wealth to income has more than doubled. We have an economy that is better at increasing paper wealth than productive assets and real incomes. This growth in asset prices and house prices has disproportionately affected the richest 10%, who are of course more likely to own property and houses. In fact, the country's 10 wealthiest families have seen their wealth increase 280% since 2008. The financial crash wasn't a disaster for everybody. In the UK, the poorest 50% of the population own less than 5% of the nation's wealth. The top 10% now earn 57%, and in the past decade that gap between the richest 10 and the poorest 10% has grown 50% in absolute terms. However, wealth inequality may actually be greater than statistics suggest. Research at LSE suggests the biggest English estates may be hiding at least 35% of their estates in offshore accounts or in assets not properly declared like artwork. These wealth-hiding dynasties were quite likely to appear in the Paradise Papers, an account of hidden offshore wealth in places like the Isle of Man, Jersey and Panama. The paper also highlighted how companies like BlackRock use offshore trusts to avoid paying capital gains tax and stamp duty, making it hard to reduce the growing wealth inequality. And the idea that statistics may be underestimated is supported actually by the ONS Wealth and Assets Survey, which gives higher levels of inequality than raw statistics suggest. Now, go back to the turn of the start of last century. The UK was definitely unequal. Think of Downton Abbey, rich landlords paying butlers to dress them and things like that. But after the First World War, social change led to a big decline in the aristocracy and inherited wealth. It was also helped by an increasingly progressive estate tax. In 1949, it reached a peak of 80% on estates over 1 million. Also, in the post-war period, we had a period of rising real wages, a growth in the middle classes, and a rise in home ownership. But since the 2008 financial crisis, this improvement in wealth inequality has gone into reverse. Now, wealth inequality is not always so easily observable, but increasingly set to increase. Many forecasts say it will continue to rise. Now, if we look at inequality from the perspective of income, like wealth, there was a significant improvement in the post-war period. But then, starting in the early 1980s, inequality increased quite sharply. This was due to reductions in higher income tax, decline in trade unions, the shift from manufacturing to financialisation, high unemployment, the growth of top-end executive salaries. But on the metric of income inequality, the past 20 years has actually seen some reduction. This has been helped by policies like the national minimum wage and improved pensions. But there's a few things worth pointing out. This Gini coefficient is actually quite a crude statistic. It ignores where inequality occurs. It also, of course, ignores things like housing costs, wealth and savings, which in practical terms make a big difference to quality of life and living standards. If you live in London, 2 or 3 children, pay £2,000 a month rent and transport costs, it can be hard to survive on a salary of £50,000. If you own a home outright, a small income of course goes much further. Also, when incomes stagnate, like they have done in the UK in the past 15 years, it's going to exacerbate any existing inequality. Now, if we look at the wealth distribution, the poorest 30% barely own any wealth at all. The biggest cause of wealth is net property wealth, followed by private pensions. This also shows that the top 1% are really in a league of their own, with wealth of over 4 million. The top 10% also tend to have the highest return on assets. This is because they can tend to have the luxury of investing in higher risk, higher return assets which give better returns. Also, the super rich usually in a better position to make use of tax avoidance schemes like investing overseas, something impractical for the majority of households. And one problem is that wealth often leads to more wealth because the wealthy can benefit from rising asset prices and reinvest their dividends and rent, whereas low-income households without wealth rarely have the luxury of savings and starting to accumulate wealth. And this is why wealth inequality can easily balloon if you're not careful. Now, one of the few areas where wealth inequality has improved is in the area of pensions. One successful UK policy was auto-enrolment in private pensions, and this means that many ordinary workers are now retiring with significant private pensions. Does wealth inequality matter? There's nothing wrong per se with wealth. Norway has developed a sovereign wealth fund that is worth over $1 trillion, and this wealth fund set up to benefit the whole of the economy with a diverse range of investments, which will provide the state with income to fund public services for many years to come. A genuine wealth creator who sets up a business and creates employment will increase welfare of the whole economy. The problem is that increasingly gains in wealth are not from those productive investments, but inheriting profit and rising assets. And this is creating an unequal society, which is affecting living standards and even economic growth. Already, the chance of buying a house is increasingly dependent on whether your own parents own a house. For young people whose parents don't own property, just 9% own a house themselves, but this rises to 36% for children of parents in the top third of homeowners. Disparities in wealth become a big factor in determining quality of life, especially when house prices are so expensive. Now, in recent years, the amount of wealth inherited has increased, and over the next few years, this is going to significantly increase, from an annual figure of around £100 billion to a yearly total of £350 billion by 2047. The FT estimate a total of £7 trillion will pass between generations in the next 30 years. In fact, it's known as a great wealth transfer, as the baby boomer generation pass away and pass on their wealth. When people talk of the UK going bankrupt in a social care crisis, this figure is useful for remembering there is wealth in the UK. And the challenge is how to make use of this wealth to solve some of the problems we have. Because if you don't address wealth inequality, it'll increasingly lead to a divided society between the haves and the have-nots, those who inherit wealth and those who have a big social care bill. Also bear in mind, due to increased life expectancy, the average age when an individual receives an inheritance has risen from 58 to 64. In other words, the large wealth transfers occur between older age cohorts, and this is likely to increase the wealth inequality between age groups themselves. This graph shows that it is the age group 55 to 64 who receive the largest value of inheritances. The second biggest group is the over 65s. And the age of inheritance is important for any young person struggling with a current cost of living. Inheriting wealth when you're 65 doesn't particularly help with raising a family. If you had a choice between inheriting, say, £50,000 when you're aged 25 or £500,000 when you're 65, which would you choose? I would choose to inherit a lot less when I'm young. The result is that if we look at absolute poverty rates, after taking into account housing costs, the group with the highest absolute poverty is now children. The decline in pension poverty is very welcome, but child poverty is increasingly stubborn. The cost of raising a family is one factor behind very low birth rates, which will worsen the UK's demographic headache in the coming years. So there is a growing sense that wealth inequality leads to unfair outcomes, and the most obvious, of course, is in housing. With house prices an average 8 times income, buying a house is almost unfeasible for a household on a median wage of £35,000 a year. Why are house prices so expensive? At least one factor out of many is the role of wealth in putting more money into the housing market. The bank of mum and dad, one of the biggest sources of finance, and also the role of wealthy investors buying property. Studies suggest that foreign investment has pushed up property prices, especially at the higher end. Now, as a result of higher inheritance levels, the IFS forecast inheritance tax revenues will rise from £7 billion to £15 billion by 2032-33. But this is still a really small fraction of GDP, less than 0.5%. It's only a tiny fraction of the wealth transfers involved. With a threshold of £1 million, only around 4% of estates pay inheritance tax. But despite a tiny minority paying it, it's also one of the most unpopular. Just 20% say it is fair, as opposed to 60% for national insurance. An annual wealth tax would really be quite difficult to implement. It would also increase the incentive to hide assets, and it'd probably be the super rich most successful in avoiding it. In the 1990s, 12 OECD countries had a wealth tax, but today only 3 have retained it, and even then the amount they raise is relatively trivial. Better solutions would involve a land tax and closing loopholes on capital gains and property taxes and other inheritance taxes, although the government's efforts to extend it to farmers has met a very strong political backlash. The other issue is trying to avoid future booms in house prices, which has done so much to increase passive wealth and hurt those who don't inherit anything. But that's much easier said than done. It would take a whole new video to go into that. Now, if you ever wondered whether you get wealth by making YouTube videos, check this out. I share my YouTube journey and I explain why I won't be entering the Sunday Times rich list anytime soon.